When I first jumped into trading at gunbot.com, everyone kept telling me success was 80% mindset and just 20% technical skill. However, after nearly 9 months of grinding, I realized that widely accepted ratio simply wasn't the whole truth. The actual secret sauce I discovered is a 40-40-20 split. 40% mindset, 40% money management, and only 20% technique. Seeing my results stall forced me to build everything from the ground up, especially since risk management wasn't really a thing back then in crypto. So, I meticulously engineered a money management plan designed specifically to maximize profits, while aggressively minimizing any potential losses. This robust structure will be published soon at gunbot.com, and it was my personal key to achieving specific financial milestones without risking ruin. Interestingly, by the time I started coding risk management module for Gunbot, I already had trading experience in stocks and forex, and my own established capital base. During my development at gunbot.com, I decided to take one of those challenges specifically to prove this money management system works. I wanted to demonstrate that if you stick to this method, failing a risk management challenge becomes mathematically close to impossible. To actually blow the account, you'd need to hit about 25 to 27 consecutive stop losses, which is frankly just unheard of insanity. I must clarify that I am not a financial advisor, and this is purely for educational purposes based on my experience developing Gunbot. If you find this insight helpful, please hit that like button, share the video, and subscribe to the channel for more, or visit our main website at www.gunbot.com. Now, let's stop chatting and dive straight into the core content on the slides. Today, we are dissecting money management in trading to learn how to protect your capital and maximize your profits effectively. The 3 main pillars of solid money management are risk per trade, drawdown management, and profit growth scaling. Crucially, when managing risk per trade, you must first define how much you are sorely allowed to lose, not just how much you want to gain. Most traders obsess only over potential earnings and completely ignore the vital question of acceptable downside. Ask yourself, with a $1,000 account, is losing $10 per trade perfectly acceptable? Keep increasing that number until you hit no. If losing $40 on 1,000 feels wrong, then you immediately stop and set your acceptable loss at $30. Always lock down your maximum acceptable loss figure before considering any profit targets whatsoever. My conservative baseline recommendation, which I enforce on myself, is a 1% risk per trade. However, when I am flipping an account for fun, I define my aggressive loss limit and begin the climb from there. For that aggressive flipping scenario, I might start above 5% risk, dropping to 2.5% after just 2 consecutive stop losses. Now, let's examine the specific loss management approach. Most traders are interested in the prop firm account structure. Consider a $100,000 prop account where your base risk per trade is a standard 1%, aiming for an average 1 to 2.5 risk reward ratio. My formula to trigger a risk reduction is simple: 1 multiplied by 4, meaning when you lose 4% of your total capital, you must adjust. Upon reaching that 4% drawdown, your risk immediately reduces to 0.5% per trade. This means when your balance hits 96,000, you are now risking only 0.5% on every single trade. Since the formula scales for the next level, we use 0.5 multiplied by 4, which equals 2. So we now use a 1 to 2 multiplier logic. Consequently, when you lose 2% of the 96,000, you drop your risk again down to 0.25% per trade. This action places you at a balance around 94,080, where your per trade risk is now just 0.25%. I apologize, as I momentarily got lost in the exact math for the next reduction tier, where 0.25 times 4 equals 1%. Therefore, once your balance drops by 1% of the 94,000 figure, you'll reduce your risk again, but your minimum floor is 0.25. Think about this. Even after potentially 12 consecutive stop losses, you are only down about 6.86% from the starting point. To completely fail the challenge, you would realistically need to absorb 24 straight stop losses, which is highly improbable with this method. Every time you hit a 4 stop loss streak, you lose 1%. So 24 stops equals a 6% loss multiplied by 4 sets. The real question becomes, when do you actually get to resume risking that higher 0.5% level? You return to the 0.5% risk only when your account balance climbs all the way back up to that $96,000 recovery mark. Similarly, to get back to the full 1% risk, your balance must fully return to the initial $100,000 starting equity. This exact logic, scaling down during drawdowns and only scaling up upon recovery, is how I manage all of my personal trading capital. Currently, across different portfolios, you should actively risking anywhere from 0.25 to 0.5% per trade. The loss management module is being developed and released as part of the Gunbot modules. See more at gunbot.com. Now let's transition to the profit-taking phase, specifically focusing on managing growth when you are aggressively flipping an account. Remember, for prop accounts, the maximum risk ceiling remains a conservative 1%. But personal accounts require you to define your own initial risk appetite. Let's assume for this example that we choose to risk $50 per trade, which translates to a 5% initial risk on a $1,000 account, using that 1 to 2.5 ratio. Our new formula changes slightly. We calculate 5% risk multiplied by 2.5 reward, multiplied by 4 successful trades, equaling 50% profit. Once we hit that 50% profit mark on the initial 1,000, our next risk level increases to 7% per trade. This isn't just a simple addition. The balance won't be exactly $1,500, but closer to $1,600 because the power of compounding interest is actively at play. When you hit that first target, you were risking 5% on 1,000. But next time, you risk 5% on a new base of $1,125. You see how the compound effect ensures that your capital increases more significantly with every single successful step you take. After hitting the 7% risk level, the same formula applied to the new balance brings you to a total of over $3,000. The process continues, and following the logic, you'll eventually reach a 10% risk level with a balance approaching $7,450, successfully flipping the account. I want to be absolutely clear. This process is incredibly difficult and by no means simple to execute consistently. That is why using Gunbot can make all of this perfectly automated. Without Gunbot, you absolutely need a high skill level in your strategy, immense mental fortitude, and unwavering adherence to this money management plan. If you deviate from the trading plan one single time, you will never reach these kinds of results. Period. So, let's circle back. When exactly do you revert to the previous 7% risk level after achieving those profits? The rule is simple. You resume risking 7% when you experience a 40% drawdown from your current peak balance, which was around $3,000. This mechanism ensures you have minimized the overall downside because you are only risking 7% against a much smaller base capital figure. Look, you successfully protected your equity. Your balance will not dip below that crucial $1,600 recovery line in this scenario. Let's examine some real-world practical case studies to solidify this powerful money management concept. Although I can't recall the exact date I started that specific prop firm challenge, the results speak volumes about the system's integrity. You see me start at 1% risk, take a stop, take another stop, and then successfully reduce the risk down to 0.50 and eventually 0.25. Notice how from September through December, the progress looks like a flat accumulation or consolidation period, showing no major spikes. How many people do you think could have truly withstood that drawdown period while strictly adhering to the correct money management rules? The majority of traders would have panicked and completely blown that challenge by constantly attempting to force a quick reversal. The correct action is to manage the drawdown properly and only increase risk once you surpass the $50,000 milestone. Again, once the balance climbs above $50,000, I resume risking the 0.50 level, and above $50,000, I return to the full 1%. This specific challenge, which was at Binance with BTC ETH pair, was successfully cleared after the system navigated through those initial difficult phases. After the bag closed, I had to restart the process on Gunbot, beginning from a slightly lower starting balance of $52,000. We then pushed through the remaining steps, and those final 2 trades secured the successful completion of that challenge too. Let's now look at a completely different case study from one of my actual personal trading portfolios, starting at $75,000. For this personal account, I allowed myself to be more aggressive, starting with a risk of 5% on every single trade from the beginning. Here, the rule was to reduce the risk after every 2 stop losses that occurred, which was every 3 consecutive losses in this setup. Following a small initial rally, the chart shows a much more violent downward descent because I simply broke my own trading plan at that point. When I broke the rule and kept holding that high-risk exposure, the account quickly returned almost all of its hard-earned gains back to near break-even. Once I resumed trading with the correct money management protocols, The subsequent descent became far more linear and in line with portfolio growth expectations. This shows the power of minimizing losses during downturns. For example, March was flat and May saw a significant, yet managed, drawdown. Crypto traders and gunbotters know about that period, and you can see the portfolio was managed correctly, despite the temporary setbacks. This particular case was at Crypto.com exchange, with Gunbot running at USDC BTC pair. In conclusion, think of money management as the essential airbag system built right into your trading vehicle. Remember those 3 core rules: risk per trade, drawdown limits, and structured profit scaling. Write these 3 rules down as if they were a legally binding contract, and then you must commit to respecting every single clause. Or let Gunbot handle them on your behalf. The absolute holy grail of trading, the most critical aspect, is mastering consistent, disciplined risk control. You must always quantify how much you are prepared to lose before you ever focus on projecting how much you desire to win. This singular rule is perhaps the most important trading lesson I can possibly implement in your Gunbot today. I truly hope this in-depth explanation of money management resonated with you and provided significant value. Go ahead, smash that like button, share this crucial knowledge, and let me know in the comments what topic you want me to cover next. I look forward to seeing you succeed, and I will catch you in the next video. Please visit our main website at